Welcome to the deep dive. This is where we take your sources, dig through them, and really pull out those golden nuggets, the insights you need to be, well, truly well informed. And today we've got a fascinating one. We're plunging into a corporate presentation, some financial results. And they tell the story of a company going through a massive transformation.
That's right. We're going to unpack the Q1 FY26 financials and the strategic vision for Authum Investment and Infrastructure Ltd.
Right. Their latest presentation is actually titled Making the Big Leap.
Hmm.
And our mission today is to understand, what does that leap actually entail?
Exactly. We'll look at their journey, their financial health, maybe some surprising details hidden in those numbers.
Okay, so the sources. We've got their corporate presentation, obviously.
Yep, and the official outcome doc from their recent board meeting. That includes the unaudited financials.
And we've got some questions ready to guide us.
Should help us connect the dots for you and see that bigger picture of Authum's pretty ambitious strategy.
Okay, let's start with this transformation then, this big leap.
Right.
Authum, it was incorporated way back, 1982, but the big change seems to have started around FY 2020.
Yeah, that's when it was acquired by Alpana Sanjay Danke. And historically, from fiscal 20 to 22, they were really just an investment platform, pure play.
Okay, so investing. But then...
Well, in fiscal 22, they started dipping their toes into credit, diversifying.
Okay.
And that led to some pretty significant MBFC acquisitions, its non-banking financial company, in fiscal 24.
So buying up credit businesses.
Exactly. And now the stated goal is to be a fully integrated credit platform.
That is quite a shift. From just investing to running a whole credit operation. What's the thinking there? Why such a dramatic pivot?
Well, what's really fascinating and what kind of makes it possible is the sheer scale of their net worth growth. It's kind of stunning.
How stunning are we talking?
I get this. Their net worth surged from about 420 crore rupees back in FY 2020
Okay.
to an impressive 16,670 crore rupees by Q1 FY26. That's as of June 30, 2025.
Wow. Okay, that's huge growth. 420 to over 16,000 crore.
Exactly. And that exponential growth, that's the foundation. It gives them the financial muscle for this big leap.
Right. And it's not just the internal balance sheet strength, is it? They've built up market cred, too.
Definitely. Their market cap as of June 30, 2025 was around 44,500 crore rupees.
Pretty substantial.
And they got an external rating, too. CRISIL gave them an A stable rating in July 2024.
How important are those things, the market cap, the rating, when you're trying to pull off such a big strategic change? Does it make the leap easier?
Oh, absolutely crucial. A strong market cap, a stable rating from CRISIL that signals confidence.
To who? Investors?
Investors, lenders,
Right.
potential partners, yeah.
Yeah.
It just opens doors for, future capital raising, maybe strategic alliances, things you really need when you're expanding so ambitiously.
Okay, so the foundation looks strong. Now let's zoom in on these Q1 FY26 financials, because you mentioned this is where it gets interesting, maybe a bit nuanced.
Yeah. Nuanced is a good word. Because if you just look at the headline consolidated numbers for this quarter compared to last year, it looks like a step back.
How so?
Well, for Q1 FY26, the consolidated total income was reported at roughly 1,224 crore rupees.
Okay.
But compare that to Q1 FY25, the same quarter last year, it was 1,418 crore. So income is actually down year over year.
Down. Okay, that doesn't sound like a big leap forward.
Exactly. And profit did the same thing. Consolidated profit after tax before non-controlling interest was about 943 crore in Q1 FY26,
In last year.
down from almost 1,100 crore in Q1 FY25.
Huh. So income down, profit down, but you're saying this isn't necessarily bad news.
Well, you really need to look into those top-line numbers. This dip, it isn't really a stumble. It feels more like a deliberate rebalancing.
Balancing how?
They're shifting the mix. The big leap isn't about just growing everything everywhere right now. It's about radically changing where the revenue comes from.
So sacrificing some older revenue streams to boost the new ones.
Precisely. It looks like they're consciously letting the traditional investment revenue slide a bit to really supercharge this new credit business. You have to peel back the layers.
All right, let's break it down by segment. Where's the action?
Okay. Lending activity. This is the star, the core of the new strategy.
Right.
It brought in about 717 crore rupees in revenue in Q1 FY26.
Okay, 717 crore, and last year?
Just 116 crore in Q1 FY25.
Whoa. Okay, that is a massive jump from 116 to 717 crore.
Exactly. That shows you how fast they're scaling up this credit business.
And the flip side, the traditional investment part.
That saw a big decline. as you'd expect with this strategy. It generated about 502 crore in Q1 FY26,
Compared to?
almost 1,300 crore, 1,297 crore, roughly, in Q1 FY25.
Okay, so a huge drop there, a huge jump in lending. That really shows the diversification playing out.
It really does. And you also see the very beginnings of new streams, like the asset reconstruction company, the ARC segment.
How much did that bring in?
Tiny for now. About 0.46 crore in Q1 FY26. It just got activated, so it's early days.
Right. So overall income down, but driven by a deliberate shift towards lending. What about costs, though? Did they manage expenses?
They did, and this is kind of the silver lining to that overall revenue dip.
Okay.
Total consolidated expenses for Q1 FY26 were just about 81 crore rupees.
Down from...
Down significantly from 209 crore in Q1 FY25.
Wow, that's a big reduction in expenses. Effective cost management, it seems.
It certainly looks that way.
But I wonder, as they scale up this credit business, isn't that usually more operationally intensive, higher costs? How sustainable is that reduction?
That's a fair question. Scaling lending often does bring higher OpEx over time. They might be benefiting from initial integration efficiencies, maybe?
Maybe. And what about liquidity? Cash looks good.
Yeah, liquidity looks robust. Cash and cash equivalents actually increased quite a bit, up to 12,247 crore by June 30, 2025.
Okay, strong cash position. But borrowings also went up.
They did. Borrowings and payables rose to about 2,586 crore.
So cash up, but debt up too. Any concern there? Even if the leverage is low now, that's a rapid increase.
Well, the company makes a point of highlighting what they call minimal net leverage.
Meaning?
They note that their third-party credit, so actual borrowing from others, is less than 0.1 times their net worth.
Ah, okay, because their net worth is so huge now?
Exactly. The borrowing is still very small relative to their equity base. It suggests that while debt increased to fund the expansion, it's manageable within their current structure.
Makes sense. The challenge, I guess, is keeping that discipline as they keep growing.
Always the challenge with rapid growth, yeah.
Okay, let's dig deeper into these business segments. They seem to be the real engines here. The investment business first, even though segment revenue dipped, you said it's still strong.
Oh, yeah. Definitely don't overlook it. It's still a powerhouse.
Yeah.
They have cumulative unrealized profits of 5,518 crore rupees from their existing investments.
Unrealized, meaning gains on paper they haven't cashed in yet.
Exactly. And get this, just in Q1 FY26 alone, they added another 12,206 crore in unrealized profits to that pile.
Wow. So that's like a hidden asset almost.
Mm-hmm.
Over 5,500 crore just sitting there in potential gains.
It's a massive strategic cushion. It gives them huge flexibility.
Flexibility to do what? Sell some off to fund the credit side?
Could be. Or to make other big strategic investments. It's a source of future capital they can tap when needed.
And are they making interesting plays on the investment side still?
Seems like it. They mentioned focusing on plays designed for outsized returns, like Pradab Snacks.
The snack food company.
Yeah, they bought about a 42% stake in them back in September 2024 for around 765 crore.
Okay. Any others?
NITCO Limited. It's a lifted tile manufacturer. Authum bought up about 97% of its consortium debt.
Bought the debt.
Yeah, and then converted some of that debt into equity. So now they hold roughly 44.6% of NITCO's shares.
Interesting. So using debt strategically to gain equity control shows some creative value generation.
Right. It's not just passive investing. It's structured credit solutions creating value.
Okay, now let's pivot to the core of the big leap, this credit business. The scale up seems incredibly fast.
It really is remarkable. A key piece was acquiring Open Elite Developers Limited that used to be Reliance Commercial Finance.
Ah, the Reliance connection.
And also the business of Reliance Home Finance Limited. They did this in FY24.
And what did that give them?
Basically, a fully functional credit platform ready to go. It came with an agency network, systems, the LOS and LMS you need for loans.
Loan origination system, loan management system.
Got it. Plus 25 branches and a team of over 425 people.
So they essentially bought the whole setup, the infrastructure, the people, everything.
Pretty much. It was a massive accelerator for getting into the credit space serious.
And the results, the actual new lending.
Explosive, really. The outstanding fresh business in their loan book. So new loans they've originated.
Yeah.
It went from just 33 crore rupees in March 2022
Tiny.
to 1,384 crore by June 2025.
Wow. 33 crore to nearly 1,400 crore in, what, just over 3 years?
Yep. And they say it's driven by deploying over 3,000 crore in new credit over just the last 2 years.
Okay, that kind of growth rate. What does it tell you about their execution? Can they keep that pace up without, tripping up quality control?
It tells you they've integrated those acquisitions effectively and are hitting the ground running. The big question mark, as always with rapid scaling, is risk management.
Right. Maintaining credit quality when you're growing that fast.
Exactly. It's easy to grow volume, hard to grow profitable, sustainable volume. That's the test.
And there's another piece to this credit strategy, right? The ARC acquisition.
Yes, very important. ISARC, India SME Asset Reconstruction Company Limited.
They bought a big chunk of that.
Yeah, acquired 88.37% on June 17, 2025. Made it a subsidiary.
How much did they put in?
Invested about 313 crore rupees. This left ISARC with a net worth of 342 crore and around 327 crore in free cash ready to deploy.
And it's already doing deals.
Yep. Activated its fresh business almost immediately with an 8 crore loan buyout in June 2025.
So NBFC, now an ARC, what's the bigger picture here? Just collect different financial businesses.
It seems more strategic than that. It looks like part of a larger blueprint to build multiple diverse platforms.
Platforms like?
NBFC, ARC, they also mentioned asset management company, AMC, and servicing and advisory.
Ah, okay. So building a whole ecosystem, diversified financial services.
That seems to be the vision. Multiple engines.
Let's shift gears slightly. Leadership. Any changes at the top during all this transformation?
There have been a couple of notable updates recently, yeah. Corporate governance moves.
Such as?
Mr. Amit Dangi, who's already whole-time director, has been designated as the chairman of the board. That was effective July 14th, 2025.
Okay. Internal promotion to chairman.
And there was a change in the company's secretary and compliance officer role. Ms. Avni Shah resigned on July 14th.
And replaced by?
Ms. Dipyanti Jaiswar. She started July 15th and apparently brings over 9 years of experience in corporate governance.
What's the significance of moves like these right now, during the big leap?
Well, having a chairman who's deeply involved operationally, like a whole-time director, can signal focused execution from the top.
Right.
And bringing in an experienced compliance officer is crucial when you're growing fast and diversifying. Ensures your governance keeps pace with the business complexity. It points towards professionalizing for scale.
Which ties into their stated way forward, right?
Exactly. They're focusing on diversifying revenues, being smart about allocating capital between investments and credit.
And this idea of platformizing and professionalizing for scale.
Yeah. Building multiple self-sustaining growth engines. It's a long-term vision.
Definitely sounds like a blueprint for an integrated financial powerhouse.
That seems to be the ambition.
Now, for a really complete picture, we have to touch on something potentially tricky. The auditor's report. They included an emphasis of matter.
Yes. Specifically regarding the subsidiary, OEDL Open Elite Developers Limited.
Right, the one they acquired from Reliance.
Yeah.
And just so everyone's clear, an emphasis of matter isn't the auditor saying the accounts are wrong.
No, not at all. It's the auditor highlighting something that is properly disclosed in the notes, but is so important that they want to make sure you, the reader, pay special attention to it.
Okay. So what did they emphasize about OEDL?
A few things. First, there's an old legal matter reported back in June 2019 under the Companies Act that's still pending with the Ministry of Corporate Affairs.
Okay, a lingering legal issue. What else?
Second, and this is significant, OEDL has big accumulated losses, about 890 crore rupees as of June 30, 2025.
Ouch.
Which results in a negative net owned fund. And the auditors state this casts significant doubt on the company's ability to continue as a going concern.
Negative net worth, basically. So how is it a going concern?
Because Authum, the parent company, has stepped in. They've provided what's called comfort, basically a guarantee to meet all of OEDL's future obligations.
Oh, so the parent is backstopping the subsidiary.
Exactly. That allows OEDL's accounts to still be prepared on a going concern basis, but it highlights the subsidiary's underlying weakness.
Got it. Anything else in the emphasis?
Yes. Third point. SEBI, the regulator, hit OEDL back when it was Reliance Commercial Finance with a 25 crore rupee penalty in August 2024.
What for?
The order also restrained it from the securities market for 5 years. OEDL appealed, got a stay.
Meaning the penalty is on hold?
Kind of. The stay was conditional on them depositing half the penalty amount, 12.5 crore, which they've done. But the appeal is ongoing.
Okay. So, pending legal matter, significant losses raising going concern doubts, but backed by parent, and a hefty regulatory penalty under appeal. These are important bits of context.
Definitely. They seem to be legacy issues from the acquisition, and Authum is actively managing them, but they are part of the package, part of the transformation story.
So let's try and wrap this up. We've explored Authum's really ambitious big leap
Mm.
from being just an investment house to becoming this diversified credit and alternative assets player.
We've seen that incredible net worth growth providing the foundation.
Right, and the rapid, almost explosive expansion in the credit business, especially through acquisitions.
Even while navigating, as we discussed, that nuanced Q1 performance where overall income and profit dipped year over year.
But that dip really reflects the strategy, right? Shifting the revenue mix deliberately.
Exactly. It's a strategic rebalancing in action.
Authum's journey, it really showcases a company making some bold, aggressive moves.
Definitely. Underpinned by that strong balance sheet growth, but also, as we just discussed, having to manage these legacy challenges from the companies they bought.
Which brings us to our final provocative thought for you to consider.
Yeah, think about this. Authum is balancing these huge, unrealized gains from its investment past
A big safety net.
with this very rapid and probably quite complex build-out of a whole new credit empire, complete with inherited issues.
So what does this bold strategy juggling those gains while managing the risks of rapid credit expansion and integration? What does it really suggest about the risks and rewards inherent in these kinds of high-stakes corporate transformations, especially in today's, very dynamic markets?
It's certainly something to ponder. How do companies successfully integrate potentially problematic assets while simultaneously pushing forward so aggressively on a brand new path? Lots to think about there.